We're going to look at Simon Property Group, and this is the first video I ever did on this channel, was this company. But someone asked me to do this company again, and I've done over 150 companies with my discounted cash flow model. So my model has been really refined and improved quite a bit. Because when I started the channel, the way I got the model was I just watched other YouTube videos and just copied their models. But the model has improved dramatically from doing so many deals, especially REITs. I'd say close to half of the tickers I look at, the model doesn't fit. Like, the result is a value of the company which is so far above or below what they're trading at. So that's where I have to use my industry knowledge and make assumptions and sometimes alter the model a little bit. So let's get started with Simon Property Group for the second time. So their market cap is $18.93 billion. $18.93 billion, and they're trading at $61.90. So now we know the shares outstanding because it's the market cap, $18.93 billion, divided by the stock price, $61.90, equals the shares outstanding, 306 million. A REIT is a company that buys real estate and leases it or rents it out to individuals or companies and uses those payments to pay its investors in the form of dividends. So now I'm pulling the free cash flow. Free cash flow is total cash after operations minus capital expenditures. And this is how you value a company. You estimate their future free cash flows, and then you discount those values back to today. And that gives you a value for the entire company. We also need net income for the model, and that's on the income statement. And that's the profit and loss for the business. And we're also going to pull revenue, which is on the income statement, and that's total sales for the business. For a REIT, that's the rental and lease income they receive. And we'll look at the numbers just to make sure they look okay. And when I say okay, I just mean they're fairly consistent and they're positive. And this hits both those marks quite well. Their free cash flow is in a tight range. Net income is also in a fairly tight range, and so is revenue. So we could definitely value this company and get a good value. If the numbers were all over the place, like free cash flow went from negative $2 billion to positive $10 billion to negative $6 billion, it would just be impossible to value. So now let's get their discount rate so we could figure out what to apply to the future cash flows. So we have to look at their capital structure. So their interest expense is on the income statement. That's the interest they pay on their debt. That's $790 million. And now we'll go to the balance sheet. We want to see how much debt they have. And we'll go to the liability section. The current debt is debt due within 12 months. That's $1.3 billion. And then non-current liabilities, long-term debt, that's debt due after 12 months, that's $23 billion. So they pay 3.3% interest on their debt. And REITs don't pay taxes, so the cost of debt is the 3.28%. Now let's figure out the cost of equity. We need the beta for that. That's the volatility of the stock, how volatile the stock is relative to the overall market. And their beta is 1.34. That means the stock moves a little more than the market moves. So if the market goes up 1%, this stock should go up around 1.3%. Or if the market goes down 2%, this stock should go down about 2.6%. Let's get their current assets. Those are assets that can be easily liquidated into cash within 12 months, and that's $2 billion. And I'm pulling some of these numbers because we look at the ratios of the company at the end of the video. Let's pull their current liabilities, and these are debts or payables that are due within 12 months, and that's $4.3 billion. and their equity. That's the total value of the company according to the balance sheet. That's total assets minus total liabilities, and that's 2.5 billion. And we'll pull their EBIT, earnings before interest and taxes, or operating income. 2.9 billion is how much money this company generates from its operational business, but before it pays interest, expense, and taxes. So now we know the weighted average cost of capital because it's a blend of the cost of debt, 3.3%, and the cost of equity, 12.6%. So the WACC is 4.2%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, and we usually don't estimate forever. What we do is a terminal value, which is all years past year 4, and we use the Gordon growth model or dividend discount model to figure that out. We discount all those numbers back to today's value using the weighted average cost of capital, and then we come up with a value of the company of $24 billion. We divide that number by 306 million shares outstanding. We get an intrinsic stock price of $78. It's trading at $62, so it's a buy according to the model. It's trading at a 20% discount. So you can see the stock price has traded well above intrinsic value. Looks like it was close to $200 a few years ago. The 52-week range was between $42 and $165, so it has a pretty wide range. I think most stocks are at a pretty wide range this past 52 weeks because of how volatile the market was with coronavirus. Let's look at the financial ratios of the company. So they have a PE ratio of 9, which is really good. I like to see under 15. That's price of stock over earnings per share. They also have a pretty good price to sales ratio, 3.3. They have a pretty high price to book, 7.5. I like to see around 3 or 4 or even less. So that's price of stock over book value per share. That means investors are willing to pay $7.50 for $1 of book value. Remember, when I say book value, I just mean balance sheet, total assets minus total liabilities. They have a terrible current ratio. It's only 0.5. They can't even cover half their current liabilities, so they may need to take on more debt, which is not a good sign. ROE of 83%, they provide a great value to their equity holders. That's income, net income over equity. A good interest coverage ratio of 3.68, that means they could cover their interest payment more than 3.5 times. Not really sure why they have such low current assets. Maybe they're just really efficient and using their extra cash to buy new properties. Really high debt, 91%. That's not good at all. This is the 14th REIT I've done in this channel, so I have so much information to compare them to. So I have all the ratios inside here, PE, PS, PB, and then I have the winner for each category, and then I have the average for each category. And Simon Property Group is right here in the middle, and if it's green, that means they're better than the average. If it's red, that means they're worse than the average. So their PE is 9, which is better than the average, great PE. Pretty good price to sales, 3.3, which is half of the average. Average is 6.4. They have a high price to book relative to their peers. They have a terrible current ratio. That's something they need to look into. Great ROE. They have the best ROE amongst all the REITs. So they're providing great value to the equity holders. They have the most debt amongst the REITs, 91%, so they don't have much room to borrow. They're higher than the average in market cap. They're 18 billion market cap. The average is 12 billion. But American Tower is the largest by far, larger than the other 12 REITs combined. The other 12 are 63 billion market cap. They're 108 billion. And let's see their probability of default within the next 12 months. 45% probability of default. That's because of their current ratio and their high debt and other factors too. So that's just my personal calculation. It's only my opinion. But let me know what you think in the comments. I love comments more than anything else. So please leave a comment. Thanks for watching.